good news is from 1970 forward, we had unmatched growth. The bad news was driven by debt. How bad is the economy? There certainly has been a lot of money spent to try to create recovery, and the question is, has it been effective? If you look back at the last 30 to 40 years, you'll see an incredible expansion in credit, incredible expansion in gross domestic product, an incredible expansion in our economy. Truly, it's been something which is unprecedented. The scale, the scope, the measure of success, globalization, and the wealth created over the last 30 to 40 years has been never achieved at this scale in history. We watched our national debt go from less than $2 trillion in total to more than $14 trillion. And if the truth be told, if you include Fannie Mae, if you include Freddie Mac, if you include the off-balance sheet liabilities, $14 trillion is a small number. It's more like $20.7 trillion in total liabilities. And those are current liabilities, not the future unfunded liabilities, which would include Medicare, Social Security. Every day that Washington, D.C. neglects tightening the belt, we get closer and closer to a dollar collapse or a debt default. The crisis that we saw over the last 2 to 3 years has basically done one thing. It's taken a lot of those private sector liabilities and moved them to the public balance sheet. That's why one of the most important things to get now is what's happening in the Treasury market and what's happening with the U.S. dollar, because that is critical. And it's a direct consequence of this shift from private liabilities to now public responsibility to pay. We had the democratization of credit for 30 years, and now we have the socialization of risk. If debt was what fueled the economy, if GDP was dependent on it, there was one other variable which is important to remember too, and that was that the savings rate, once at 12%, is now in the 1 to 2% range, and in fact has gone negative on a number of instances in the last decade.
Well, I trust you had a good year.
Good year? Well, between you and me, Mr. Carter, we're broke.
Yeah, very funny.
The other contributor to growth in that period was the spending of savings. In the period from 1958 to 1982, you had a very high savings rate, between 8 and 12%. And then, when we got to 1982, you began to see that savings rate decline all the way down to, in our modern era, nothing. Nothing. That is what fueled growth in the economy. That is what fueled growth in the S&P 500. Let's look at the stock market. In that same time frame, say from 1966 to 1982, you have a bear market in equities. While you have a high savings rate, you have very little going on in the stock market. And then when you transition and people begin to spend their savings, all of a sudden the S&P 500 marches higher and the stock market moves to record highs in the year 2000. During the last equity boom, 1982 to 2000, you had those two drivers, an increase in debt and a decrease in savings. Are those the elements we have setting the stage for a new bull market in equities? I think not.